This is the Financially Simple Podcast, a show dedicated to destroying the complexities of money for today's small business owner. And now, here's your host, pizza-loving, certified financial planner, Justin Goodbread.
Welcome to Financially Simple. This is a finance show for small business owners about money, how it works in our business and personal lives, and how we can build wealth to be financially independent. I'm your host, Justin Goodbread, and today we're dealing with the topic, the key language to understand in value growth. Let me say that again. This is the key language to understand in growing the value of your company. Now, friends, before I jump into the meat of the podcast today, I realize we're on a journey to grow the value of our business. We're dealing with that currently in the series that we're doing in the podcast. And I realize the name of the podcast is Financially Simple. I get it. I'm also aware that you're probably working out, driving a car, or maybe you're standing in front of the oven watching some really good, tasty sausage pizza rise. I can see the mountain of cheese just bubbling on top. Maybe you're doing that. So let me go ahead and apologize for today's content. Unfortunately, I need to cover some concepts today, and these are probably the hardest concepts for someone to communicate in a 15, 20-minute conversation or in a podcast. I thought about taking each one of these points and doing a podcast individually on each of these points we're going to cover today, but I figured it's kind of like trying to eat some pineapple on pizza. Just buck it up, bucko, get through it, swallow it down, and go grab you pieces of sausage. I wanted to make this one short, sweet, to the point. But you're like, okay, so Justin, if it's that exciting, why in the world are we covering this? So here's the deal. These are some of the most important concepts to quantifying decisions you make in your company. Questions like, should you hire somebody? Should you fire somebody? Should you expand or should you contract? Should you buy that piece of equipment? Should you invest in this particular piece of software? Every answer to those questions can be quantified from the content of today's show. So I want to jump into some terms and give some very simple definition to some terms. And with these terms, I want you to understand that if we're trying to grow the value of our company, then these are some terms that we're going to hear. We're going to hear our consultants talk about them. We're going to hear our accountants talk about them, perhaps even our attorneys talk about them. I know if you're working with a firm like mine, a comprehensive business and wealth management firm, that you are going to hear me talk about some of these things. So I want you to be somewhat familiar with them. And I want you to have a baseline for the conversations going forward. Remember, we're trying to grow the value of our company. In order to grow the value of our company, we have to know how it works. We have to know the basics. It's kind of like driving a car. We don't have to know how to build an engine. That's the mechanic's job. But we do have to know that the brake is on the left, gas is on the right. You do put gas into the motor. You have to have oil in the motor, and the tires have to be pumped up, and you have to obey the laws. Same scenario works when it comes to growing the value of our company. We have to understand some basic things. So without further ado, let's jump into the heart. Let's jump into the heart of one of the hardest podcasts that hopefully I'll ever do. And let's deal with some terms. So the first one I want to deal with is, what is cash flow? You know, cash flow is one of those terms that we often hear. How's your cash flow in your business? I heard someone the other day, does that thing cash flow? And they were talking about a particular segment of a company that we were working with. And for many people, we use the term cash flow, but then when I ask, well, what is cash flow? Probably one of the most popular explanations I get is, well, Justin, it's EBITDA or it's EBIT. And EBIT or EBITDA stands for earnings before interest and tax. That's EBIT. Or earnings before interest, tax, depreciation, amortization. That is EBITDA. But it may be a common use to say, well, my cash flow is the earnings before I pay my interest and taxes. That's how much my cash flow is. But is it? Is that true? Not necessarily. And even more important is that EBITDA is an average that's used in the industry, but it also can be misleading. In fact, EBITDA can be manipulated. I want to give you an example on why cash flow can be misleading. So here's an example. If someone were to say, yeah, I'm going to use EBITDA, earnings before interest, taxes, depreciation, amortization, that's my cash flow. What do you do whenever someone has financed a piece of equipment? So I'm thinking of a particular client of ours. They have financed about $800,000 worth of equipment. And if I look at the EBITDA, then it looks like the company has a ton of money in cash flow. But where they're at right now on their loan, the interest is factored into EBITDA, the taxes, but what about the principal? The principal is often not factored. So EBITDA is not really a good figure to figure out what your cash flow is. Then you run into other things that cash flow can vary. And so where one company may use EBITDA as a measuring tool, other companies may not. What do you do with things like a one-time expense, which happen maybe once a year, or a one-time bonus or one-time profit? I've known companies that receive one big sort of income, maybe one order, and it's just such an anomaly. Well, what do you do with that? Or I've seen companies where they have one big expense. I saw one company that had about a $200,000 legal expense in 1 year's time. Totally out of the ordinary. 25 years of operation, 1 year legal expense. Well, that's where we go into a factoring that says normalizing cash flow. Have you made your cash flow look like a non-business owner or an independent person would look at the cash flow? And so what normalizing is it's a process of adding back expenses or incomes to the company's profit and or loss statement, which is unusual and maybe not needed to maintain the operations of the company. And it could be a non-recurring expense. It could be a business-related expense. It could be out-of-period expenses. So at the end of the year, oftentimes especially last year with the tax change, we had clients go and make a lot of out-of-period expenses. They were looking at things that they were going to have to pay in January for expenses they had incurred in December. But then we had them go ahead and buy additional supplies or additional expenses in December, which was out of the ordinary. It's out-of-period expenses. So you would add back those various expenses. Maybe it's an over-the-market expense or an under-market expense. Everything that we're looking at it as a new independent owner of a company. I even know business owners who will use their business, legally of course, to travel with, to purchase rental houses with, maybe vacation home as investment properties. But would an independent operator do the same thing? And is this cash flow? You see, cash flow is one of those words that we say, well, does that business cash flow? But whenever we start analyzing the nuances or the details around it, we realize quickly that, man, what really is cash flow? So the absolute best way to track your company's cash flow is to do a calculation called free cash flow to the firm. Or free cash flow to the company. It's referred in the finance world as free cash flow to the firm. Now look, because of the level of today's podcast, I'm not going to give you the calculations for free cash flow to the firm or these other concepts we're going to talk about. I'm not going to do it. It would be very hard for me to provide you those while you're exercising or while you're watching the pizza cook. I'm telling you, I don't care about free cash flow to the firm whenever there's pizza in the oven. Let's just be honest. You're a better soldier than me. But what I'm going to do is recommend you go to the Financially Simple website and look under the heading podcast. Today's episode number 73. And under the heading podcast, you'll actually see these calculations. So free cash flow to the firm is what we would calculate to find out what is our free cash flow? What is our cash flow that we can utilize for other investments or for other initiatives within the organization? And let's look at it from a slightly different angle. Let's say that your company has invested in other companies. So Heritage Investors, our wealth management firm, is a registered investment advisor with FINRA. And that company owns Financially Simple, which is the program you're listening to. So how can Heritage Investors look at the cash flow of Financially Simple? Well, that comes into what's called free cash flow to equity, or FCFE. And that is where one company has an equity stake in another. That's another calculation you can make. Perhaps outside of cash flow, one of the most popular calculation that I've seen, I'll hear, what is your cash flow? And then I'll hear, what's your working capital? That's often used in the banking scenario. I hear in the manufacturing industry a little bit, sometimes in the medical field, but it's not a term that's often used that I see, maybe you have, but it's not a term that I often see used in the service industry. Let's say construction people, pool builders, home services people, HVAC companies, just other blue collar mom and pops. It's just not a term that's used. But, working capital does have viability in a calculation. And basically the capital of the business that is used in the day-to-day trading operations. So whatever your companies use to operate, that is what working capital is. And it's a simple calculation for the most part. It can get kind of messy real fast when you start trying to figure in accounts receivables and accounts payables and cash, just various things. But for the simplest terms, basically you're going to take all of your current assets minus your current liabilities. So let's say you have $1 million in cash and there's $500,000 in liabilities. That means your working capital would be $500,000. But working capital in terms of value can be dangerous. And I wanted to put this in here because I'm going to raise a few eyebrows whenever I say this, and I realize that. But if in fact the company, let's say it does have $1 million in cash as my example, and it does have $500,000 liabilities, and for the super simple analogy, let's say that the working capital is $500,000. Okay. If your company is sitting on $500,000 in cash, and it has been for some time, in other words, it hasn't just came in from a big sale, it's been sitting there for a while, then the value of your company could be adjusted down because of this, quote, excess cash. See, I know a particular company. The seller wanted $1 million for the company. Plus, they wanted to keep all the cash on the books. So it's not uncommon for someone to sell the assets or the goodwill of the company and say, in addition to that, we're going to collect and we're going to keep all the cash and we're going to keep the accounts receivable. In this particular case, the buyer viewed the $2 million of cash on the books as a necessity. They looked at it and said, look, you got $2 million on the books and you've had it there for year after year after year. If we look at your balance sheet year end for the last 5 years, you've had $2 million. So we're making the assumption that you need this $2 million to operate the company. And because you need $2 million to operate the company, that's only worth $1 million. Our price that we're going to offer you is substantially lower than you want or need. And in this case, the seller rejected the offer. And here we are many, many years later and the company's still for sale. You see, if the seller had simply removed the excess working capital from the company systematically over time, the buyer would not have viewed the cash as a necessity and would have offered more of a reasonable value. So that's a warning whenever you're dealing with working capital.
You are listening to Financially Simple, destroying the complexities of money for today's small business owner.
The next two terms we're going to use are often used inappropriately or incorrectly because they're so similar. The two terms are what's called the capitalization rate, or it's commonly referred to as the CAP, C-A-P, cap rate, and the discount rate. And they're tossed around all the time. Meetings. I heard one the other day where an accountant said, well, the cap rate. And then I said, didn't you mean the discount rate? Oh, yeah, I mean the discount rate. And so even the professionals many times get these two terms misunderstood. The easiest way to understand the two is this. The cap rate is a single period of time looking backwards. So you're standing on the beach, so to speak, and you're looking backwards at your feet marked in the sand. And that's a cap rate. A discount rate is you're looking backwards at each one of those individual steps in the sand, but now you're going to turn around and project out where your feet are going to be going forward. So a discount rate is a multiple points in time looking forward. So you just take a step back and look forward. You can take another step back, almost backtracking your feet as you're walking down the ocean. You're looking forward and saying, okay, I took a long stride here, a short stride here, a long stride, short stride, long stride, short stride. So you can see kind of how the future would be. So that's what's called a discount rate. So you'll use these two things, for example, in the free cash flow to the firm using the weighted average. So it's called the FCFF, free cash flow to the firm using the weighted average cap rate. You can also use it in the free cash flow to equity using the cost of equity measurement, or the free cash flow to the firm using the weighted average cost of capital. You can also use the free cash flow to equity using the cost of equity. So now that I've just given you 4 different calculations that sound like the Russian language of somebody, actually I was just talking to one of my dear friends he's from Moldova, and all the time giving him a hard time. I was like, dude, you're from Russia. And he swears. He's like, no, I'm not from Russia. I'd love the guy to death. He's one of my best friends in the world. I think he knows like 4 languages. Pretty amazing. That's what I probably sound like to you when I just mentioned free cash flow to the firm, free cash flow to equity. My point here is for you not to have to memorize each of these terms or even know how they're calculated. That's not your job. You don't have to deal with that. But what I do want you to realize is that there is a thing called a cap rate. And a cap rate is used in a single point in time looking backward. And there is a discount rate. And so when someone says we're going to discount the company, that's not a bad thing. It's just part of a calculation. That's the way the term used. One time I said we need to use a discount rate, and the client's like, why? Well, you're not discounting my company. No, it has to do with the calculation on how you value something. So that's my whole point there. Another one that we want to look at is what's called a risk-adjusted cost of debt. The risk-adjusted cost of debt. So debt costs us. We know that. Many times we'll say, yeah, Justin, it costs us the interest rate. No, if we're looking purely at the interest rate, the debt is often the cheapest amount of money that we can use. We may use that in a different conversation for a different podcast, but debt is cheap. Equity is expensive. Equity is so expensive, guys. Cash is expensive. Debt is cheap when it comes to business. Now, for your personal life, I'm totally against debt in the personal life, with the exception of a mortgage. I think everything else should be paid for, no debt. But whenever we're dealing with the risk-adjusted cost of debt, what we're looking for is we're trying to discover the hidden cost of debt embedded in loan agreements. So things like a blanket lien. Sometimes you'll hear these as a UCC number 1 filing. It was one of the terms. It's a blanket lien. Many times we'll have clients who will go out and borrow $5, $6, $7, $1 million, $2 million, $5 million to buy a business, and the bank, whoever the underwriter is, puts a blanket lien, puts a lien across the entire company, all the assets, all the income, all the accounts receivable, everything. And if that company defaults in any way, then the bank or the creditor in this case, they are going to be able to secure this asset or try to sell out the asset. Well, whenever you have a blanket lien, there are some hidden costs in there. For example, you're not permitted to do certain types of tax planning because you have debt. And then what does that blanket lien, what is it costing you if you didn't have that debt? What are some other things that you could invest this money or this other capital into? Let's say you didn't have the debt on the blanket lien, but you could turn around and go out and buy something else with your line of credit. So that's the embedded debt, the embedded cost of debt. So blanket liens are there. Personal guarantees. Personal guarantees often hurt on the sale whenever you're guaranteeing things like leases. So let's say you have a business that's in multiple different locations and now you're personally guaranteeing the lease. That can be a hindrance on the value of the company. So we have to know how to deal with that. Asset pledges. So you buy a particular asset and you're going to pledge it against another. In fact, I just dealt with a client to make a loan work. We worked with a bank and we were able to secure a little bit of money. 80, 90, 150, 200, whatever the number is, doesn't matter. Some money at the bank, and they put it into a basic CD. And as soon as something occurred in the business, the bank was going to release. So we had to pledge an asset in order to get the loan. Well, there was some cost on that. There was some embedded costs or some hidden costs on that asset pledge. This particular individual could have taken, let's just make a number up out of thin air. Let's say it's $100,000. We could have taken the $100,000 and invested it in the stock market. And, last year, 2017, it may have yielded 15, 16, 17, 20% last year. So that was a cost hidden in the debt. Bank oversight fees are also a hidden cost, and covenants, all these things. Another calculation we often run is what's called the hurdle rate. And I think I've mentioned this in the past, but a hurdle rate is thinking like you're riding down a track, you jump over the hurdles on the track and field. And so what you're trying to figure out is you're trying to examine how a project is going to be funded. And you're specifically examining the weighted average cost of capital. So oftentimes we'll have people call and they'll say, hey, Justin, I want to buy this piece of equipment. Should I buy this or should I do something else? And what we'll run is what's called a hurdle rate calculation to see, does this particular project yield the same results as investing in something else? The last one that we'll look at is the use of capital or the use of cost of capital or finance structure. So knowing cost of capital and knowing finance strategy, then we can do a number of things. We can optimize the capital structure. We can look at, should we bring in partners? Should we not bring in partners? Should we buy businesses? Should we not buy businesses? We can obviously, like I just mentioned with hurdle rates, we can look at that. We can look at the allocation of capital. How much money are we going to steer in the rate of various alternative decisions? Should I expand? Should I contract? Like I mentioned earlier, should I double down? Should I go out and buy another business, a synergistic type business, and fold him in my current company? Should I hire that associate? Should I not hire that associate? All of these things can be calculated using the cost of capital in strategy. Probably one of the most amazing things, though, is that when it comes to the negotiating and structuring of transactions, I use cost of capital calculations all the time whenever we're doing underwriting with loans. Oftentimes people, when they go to secure a loan, they'll do rate shopping. They'll try to find the best terms or the lowest rate. I'm more interested in the cost of capital. What is my money actually yielding me? And does it really matter if it's a 5% or 5.15%? Does it really matter? Sometimes it does. Sometimes it doesn't. So I give you all of these different scenarios to realize that there is, in the world of value growth, there are many different calculations. I don't expect you to memorize them all, but I want you to be familiar with the terms that I've just went over. I want you to understand that we have things like, what is cash flow? Let's answer this question for your particular business. What is the working capital of your business? And are we carrying too much? What is a cap rate or what is a discount rate? And why would we use one over the other? What does it mean to have a hurdle rate? And what is a risk-adjusted cost of debt? Does debt really hurting us? And finally, using the cost of capital scenarios as part of our financial strategy should be par for the course. This should not be foreign language to us. Once we start on the journey, which we're fixing to dive off the cliff and start swan diving or skydiving really close to the ground really fast now. We're going to start heading down there with the next episode, as a matter of fact. But I want you to understand that there are some calculations that every particular business owner can use. We can use these to grow the value of our company. The value. That's what we're after. So with that, like I said, this is a lot of information. I'm going to send you over to the blog, obviously financiallysimple.com. Under the heading podcast, today is episode number 73. Take a look at it there. We'll have it. It takes the writers a couple of weeks to catch up with the podcast. We're working on that, by the way. I've got a couple of comments from you guys saying, Justin, you're making a recording, but when we go to the blog, we can't find it. We are backlogged right now, and the team is catching up. We're trying to get our new book released, and we're going to talk about that on the show before too long. But we're really close to launching our first book, so I appreciate your patience on that. Hey, I love the comments on Twitter, LinkedIn, Facebook, Instagram. People are connecting with us. We had like 300 new people sign up last week, and I had tags. Hey, Justin, check this out. If you're not listening to me, just shoot me a question. Hey, man, I appreciate the podcast. And let me know about it. It encourages me. I love what I do, but like all of us, we want to hear a good word every once in a while. Like I say every week, life is hard, life is good. Oh, life is hard. Life is hard. I heard some bad news today on a family that I love. Life is so hard. But at the same time, I heard some wonderful news on another family, but life is good. We've all been in those hard times. We've all been in the good time. And life can be frustrating. We know that. Cost of capital? Holy cow. What are you talking about, Justin? Hey, look, money does not have to be frustrating. Let's continue to make our lives at least financially simple. Y'all go out and make it a great day.
You have been listening to the Financially Simple podcast. The information in this show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor.